Okay guys, welcome to this lesson on multi-time frame analysis. Now basically what is multi-time frame analysis? Meaning that you are looking at more than one time frame. Okay, instead of looking at one time frame, you are looking at more than one time frame. So why should you use multi-time frame analysis? Why should you look at multiple time frames? Because it increases the probability of getting into a winning trade. Okay, and you need to look at the bigger time frame to look at the big picture of the trend, and it shows the details behind price action. So if you are trading a large time frame, you want to see the details of the price action, then you go down to the lower time frame. So this means that you go to a higher time frame if you want to see the big picture, and you go down to a lower time frame if you want to see the details. Okay, the details. And also try to avoid using time frames that are too small. Personally, I don't look at the minute time frames because it's just too much noise and a lot of false signals are present over there. And also when you use small time frames, it gives you a lot of stress, and also you need a lot of screen time. So I feel that there's no point. Unless you're a good scalper, then feel free to do that. But with that said, how many time frames should you look at? So for example, if you're looking at H1 time frame, you're probably holding your trades for a couple of hours. So then there's no point looking at the monthly time frames. Understand what I'm saying? Now why is it so important to look at many time frames? If I show you these two charts over here, you have the Aussie dollar daily chart. Okay, a daily chart over here, and then this the hourly chart. So if you had to ask a trader looking at the daily chart, what trend is it right now? He will tell you, oh, it's a bearish trend. Okay, price is below 100 SMA, the long-term moving averages, price is making lower lows, is in a bearish trend. But if you are asking an hourly time frame trader, what is the trend right now? He will tell you, oh, right now it's a bullish trend. Price is making higher highs and higher lows, and moving average is sloping up. So both traders, they are trading at the same price, looking at the same price, right? Now of course there's a slight difference because I screenshot it, and there's a time gap in between. They're looking at more or less the same price, but one is telling you that it is on a downtrend, and the other one is telling you it is on an uptrend. So there's no right or wrong. It depends on the time frame that you're looking at. And the other point that I'm trying to make is that if the higher time frame big picture, if the big picture is giving you bearish signals, would you be confident to sell if you are trading in, let's say, a H4 time frame that is telling you to buy? Meaning that both time frames are giving you conflicting signals. One is telling you buy, one is telling you sell. Would you be confident to get in? No, because you want both time frames to tell the same thing. To increase your probability, you want both time frames to tell the same thing. Both has to tell you to buy, both has to tell you to sell at the same time. If there's conflicting signals, then it's better to not trade. There's always another better day to trade. Okay? So a lot of people are asking, what kind of time frame should I pick? Okay, H1, H4, D1 weekly and monthly, and how many time frames should I look at? First thing first, you gotta pick time frames based on these three factors. The first factor is your trading personality. Are you more conservative, or is your risk appetite a lot higher? So if you're more conservative as compared to if you're a high risk taker, okay, let me just write high risk taker. If you're a high risk taker, you would look at the smaller time frames. If you're a more conservative trader, you would look at the higher time frames. Now some people will say, okay, if you're more conservative, you will look at smaller time frames. There's a lot of debate about that, but personally I just feel that if you're a more conservative trader, you would take less trades. Okay, and when you take less trades, the less chance you'll be exposed to risk. Okay, the less chance you'll be exposed to a wrong trade, and hence that's why I say when you're more conservative, you would pick the higher time frames. But if you're a high risk taker, you want more excitement, you want to take more risk, and hence you will open more trades, then you would pick the smaller time frames, which would give you more trades per day, per week. And also your patience, very important. If you have higher amount of patience, you pick the higher time frame. Okay, let me just write high amount of patience. you pick the higher time frames, because when you're trading higher time frames, you need to hold your trades for days, weeks, and months rather than few hours. If you have low amount of patience, okay, low amount of patience, I write LP, then you pick the smaller time frames. Okay, and the third thing is your risk appetite. Okay, so I've explained it just now. Trading personality is kinda in line with risk appetite, but also another factor that you need to take account of is, can you hold a trade overnight? Okay, can you handle the stress of holding a trade overnight? Because some people, they really cannot handle holding a trade overnight. They cannot sleep. If you cannot do that, then you should hold your trades for a couple of hours, okay, rather than a couple of days. Because if you find yourself keep on checking the charts because you are just so impatient, you cannot sleep with an open trade, then it might mean that your trading personality is more geared towards holding your trades for a couple of hours. And also another thing you need to take note of, your lifestyle. If you are very busy holding 9 to 5 job, okay, I write busy, holding a 9 to 5 job, you have not enough time to look at charts all the time, then you need to look at the higher time frames. Okay, if you have a lot of time, okay, let me just draw a clock, you got a lot of time, then you can afford to look at smaller time frames. Okay, basically the higher time frame you go, the less screen time you need to put in, and hence the less stress. So you need to take account all these factors and then pick a good time frame. The strategies that I teach you in this course can be used in hourly time frame, daily time frame, weekly time frame. Just that most of the examples I show you are hourly charts. Okay, so basically you look at a larger time frame to look at a big picture of the trend, and if you cannot find any signals, trading signals in the larger time frame, then you can go to the small time frame to look at the details to spot entry and exit signals. So basically large time frame is for you to check the big picture, then you move down to the small time frame to look for entry points and also exit points, and you enter on the smaller time frame. Understand what I'm saying? Now then, how many time frames you look at? So if you use H4 to look at a big picture, then you use H1 to enter and to spot the details to enter. Okay, so if you use D1 to look at a big picture, then you can look at H4 to spot entry. Now the thing is, if you're entering using H1 and you're holding a trade for a couple of hours, should you look at weekly time frames? No, because even if weekly time frame is giving you conflicting signals, because of the fact that you're holding your trades for a couple of hours, the weekly time frame wouldn't affect your trade that much. Okay, but if you're talking about a time frame just like H4 and you're holding your trades for a couple of hours, if it gives you conflicting signals, then it is a problem. Okay, this means that don't deviate too far from your current time frame in which you enter. So then how many time frames you look at? Minimum 2. Okay, you can look up to 3. For example, if you are using H1 to enter, you can look at H4 and also add D1 for confirmation. If you are super conservative, right, then you can add an additional time frame, which is D1, as a confirmation. So if you are looking for a buy trade in H1, you want H4 also telling you to buy, D1 also telling you to buy. If you're not super conservative, it's still fine to look at 2 time frames, which is H1 and H4. Okay, if you are using D1 to enter, then you look at weekly chart for the big picture. Okay, and if you are using weekly chart to enter, then you can use monthly chart for your big picture. You get my point right now. And if you are trading H4, you are more conservative, you want to add one more time frame, then you can add weekly on top of that. Understand what I'm saying? But I feel that there's no need to do that. It's fine to use just 2 time frames. So some basic principles you need to take note of. First thing is, not all time frames need to be in the same direction. So I did explain to you just now, if you are entering using H1, okay, You don't want to go too far off and look at, okay, monthly chart, is it in line with my buy trade or not? Okay, so a lot of traders would think that, okay, all the time frames like M1 to monthly need to be in the same direction and telling me the same message for me to enter a trade. If you're waiting for that kind of thing, you probably won't be able to trade. Okay, because you will eventually find one time frame that's in conflict with your buy trade. Okay, so that's why I say don't look at way too many time frames, look at all time frames for confirmation, but at the same time don't look at too little, meaning just look at one time frame for you to make a decision. And also, like I said, you need to look at your duration that you're holding your trades. Like for example, as I said just now, if you're holding your trades for a couple of hours, then there's no point looking at monthly chart, okay, because you're not holding your trades for a couple of months. And ensure the time frames that you're looking at are aligned. For example, H1, H4 has to be telling you the same thing, but if it is too far off, like H1 and monthly are telling you conflicting signals, it is still okay because you're holding your trades for a couple of hours. Now the large time frame is more significant than small time frame, okay? Which means that if you see a signal in the larger time frame, meaning let's say resistance, okay? You see a resistance in the higher time frame, for example H4, but you don't see any resistance in the H1 time frame. So should you ignore the resistance in the H4? No, because the fact that there's a resistance in H4 might actually cause H1 to act on the resistance, even though in H1 there's no resistance. Understand what I'm saying? But on the other hand, if H4 there's no resistance, but H1 there's a resistance, will it cause price to bounce off in H4? No. Okay, because large time frame is more significant. The larger time frame would drive the smaller time frame, but the smaller time frame would not drive the higher time frames. Understand what I'm saying? But you know, like I said, if the higher time frame doesn't give you any entry signal, then you can zoom in into the small time frame to look at the details to spot an entry. Later I'll show you one example. Now look at this chart over here. I put in the M15 chart, okay, and H1 chart, and you realize the power of a resistance in a higher time frame. So you can see right here in H1, there's a resistance over here based on the fact that the price tested this point and also this point as a resistance, okay. But then if you look at M15, okay, an example only, I don't use M15, I'm just using this as an example. M15, at this point you don't see any resistance, right? But then the price U-turn from here. And if you avoid looking at the higher time frame, you'll be shocked. Why did the price U-turn from here? Because in the higher time frame, this is the point where U-turn because of the resistance, right? And also, what do I mean by looking at details? So for example, if you are trading in the H4 time frame, you are using this to enter, but you cannot find any bullish candlestick signal, okay. But if you go down to a lower time frame, you realize that, okay, this is a 3 white soldiers, which is a legit bullish pattern to get into, because one candle in H4 takes 4 hours to form, whereas this one big candle is actually equivalent to these 4 blue candles. So this is what I mean by looking down one time frame for you to spot the details. If you cannot find any entry signals in a higher time frame, then it pays to go down one time frame and then look at the details. Okay, let me give you one example on how to enter a trade properly. So apply whatever they have learned. Of course, I didn't put in 5 EMA because we're not trading breakouts. And assuming that it has already touched 20 SMA and you have your 50 above 100, 100 above 200, okay? And the price, of course, it retraces down to 100 SMA, give you kind of like a Morningstar pattern or 2 candlestick pattern, which is bullish engulfing pattern. And at the same time, RSI gave you an oversold signal. Let me just rub this off first. Okay, so potentially you can enter right here. Put your stop slightly below this pattern or below the 100 SMA, and then you can ride the trend from there. But before you enter the trade, remember to check the higher time frame. Is it telling you to buy or sell? Is it telling you to buy? Okay, so if you shift to higher time frame, we are at this point. Is it giving you a buy trend? You see at this point, 50 above 100, 100 above 200, everything is stopping up, so good to go. Even though it is not testing a support level, it is still fine. Only later on you realize that this is a support level, because when you are here, you cannot tell, right? If it doesn't test any support level, it's still fine, because the main function of the higher time frame is just to make sure that the big picture is in line with your buy or sell trade. Okay, so every time before you enter a trade, look at H4 first, then after that go to H1 to enter. If you are looking at H4 for entry, then every single time before you open a trade, look at D1 first before you go back to H4 to enter a trade. Okay, so I hope that this gives you a clear idea on how to use multi-time frame analysis. So with that, I'll talk to you in the next lesson. Bye.